M's and W's occurs frequently in the markets. However, not all of them are valid for trading, meaning that some are put in the market flow as a way to trap traders and fake out and then hit their stops, accumulate liquidity, and so forth. In this video, we'll talk about an M and W trading strategy that can simplify your trading. But before we go through, make sure you subscribe to this channel and check the notification bell icon so that you won't miss any of our videos as we upload. So here's the strategy definition. M's and W's are actually powerful at the high of day or low of day, or HOD or LOD in short. The first step of the strategy will be to see the cycle on the M15 time frame. What is the cycle? A cycle is basically a 3 impulse move, or in other words, a 5 wave move if we are talking in the context of the Elliott wave theory. The end of the cycle is always the LOD or HOD. That means after 3 impulses to the upside, right, this point is actually an HOD, and the contrary is true. This point is actually an LOD. So below are the steps of getting the HOD or LOD. So we need to use some indicators that will help us to see these impulses with ease. These indicators are basically an EMA or exponential moving average applied to close with period 13, and then EMA applied to close with period 50. After that, these are actually applied on the markets and are used as this. In this case, we can see that the first impulse we need to see a 1350 EMA crossover. Then after that first impulse, which is 1, the second impulse, which is the second impulse, we need to see a bounce on the 50, another bounce on the 50 for the third impulse. After this last bounce on the 50, we are now anticipating to see an M in this particular context or a W in a downward market flow. At this point, after seeing this first leg, we expect to see the second leg where we are going to make our entry after a candlestick reversal pattern. Any candlestick reversal pattern is issued on the second leg. So here are the trade parameters. The first thing is actually to see 3 M15 impulses, or basically 5 waves when we are in the Elliott wave context. Then to wait for the second leg at the third impulse. That is, after having 3 impulses, we wait for the second leg where we are going to see a candlestick reversal pattern, right? So this candlestick reversal pattern can be any candlestick reversal pattern of your choice. We have a lot of them: hammers, morning stars, bearish engulfing, bullish engulfing. There are a lot of them that can be presented at the second leg. Then falls, the stop loss must be above the second leg. So we just actually add the spread for that particular pair to the distance above the second leg. Then take profit should be at the 200 EMA. So this brings me to the third indicator that we are going to require, which is the 200 exponential moving average applied to close. So it should be at that zone. So here is our first example. In this case, we can see our first thing is to see this blue one is the 50, this red one is a 13 EMA, and this is a 200 EMA. The first thing is to see 50 13 EMA cross, which occurred at this point, meaning this was impulse 1. Then the market came back and retest 50, which is the blue one, right? So be making this the second impulse. The market went down, retested the 50, giving us the third impulse. So this was the third impulse. after third impulse, we need to see the pattern. In this particular case, it was a W. First leg was issued, second leg was issued where a railroad track candlestick reversal pattern was issued. So our entry was at this point, stop loss below the second leg, take profit at the 200 EMA, which is at this point, right? Let's have another example. First thing we need to see the 1850 EMA cross, right? Then an impulse, which is 1, consolidation at the 50, which is retest of the 50, first retest, and then impulse 2, and then retest of the 50 again, right? And the market went down. At this point, at the end, we actually managed to see first leg, second leg, where we had a candlestick reversal pattern, entry at this point, stop loss below, and then our take profit at the 200 EMA. So let's have the last example, which now consists of a varied theme. In this case, we had 1350 EMA cross 1, right? Bounce on the 50, which is 2, and then retest of the 50, which is 3. At this point, we had some a very ugly M pattern where we had this first one, right? And then the second one that came in the following day, just before the London session. At this point, it was, or it may be, something that is very difficult, especially to those who are not yet trading this, or who haven't traded this method for quite a long time. But with time, you'll be able to see a varied theme where we can actually confirm this with divergence with another indicator called the Traders Dynamic Index. So our entry from this point, our exit at the 200 EMA, which is the one in white, right? Like that. So that brings us to the end of our today's video. And before we close off, we have this advanced institutional market maker method course that is actually going for $99. So you'll be able to learn all these stuff in this particular course and actually revamp your trading. It's actually a simplified recorded course that you can access after your payment, and you can do so by contacting us maybe on WhatsApp, or you can actually do so on Telegram using the link that I've left in the description box below. See you on the next one.